Today on the show, I have the pleasure of speaking with Chad Sutton. Now, Chad is one of 5 managing partners at Quattro Capital, which is a multifamily investment firm. He leads the acquisition team, and he's also the host of a great podcast, which I've been on, called the Real Estate Runway Podcast. Now, Chad, like me, is also a recovering engineer, and he spent most of his professional career in corporate America in spaceflight with NASA and then in aircrafts with GE before he found his passion as a real estate investor. Now, Chad is a self-proclaimed old soul, and he's a genuine family guy, passionate about building quality time with his family and a quality lifestyle, but he's also really passionate about building quality communities for his residents. I'm really pumped and excited to have him on the show today to share his incredible insight and knowledge. But enough out of me, let's get him out here. Hey Chad, welcome to the show. How you doing today, mate?
Hey, mate. Good to see you. Thanks for being on the show. That's my best Aussie right there. I hope I did well.
Mate, just don't give up your day job is what they say, you know. Trust me, my American accent's shocking. Everyone's like, you've been here for so long, you should have a really good one. I was like, yeah, no, not that great, not that great. Maybe after a few beers, I get a little chirpy, but that's about it. So, mate, the first question I ask on the show to all my guests is rewind the clock and tell me how you made your first ever dollar as a kid.
You know, you mentioned this in the pre-show, and I had to think back like, oh my God, how did I make my first ever dollar as a kid? But, thinking back, I guess I always had a little bit of entrepreneurial spirit. My parents started paying me an allowance to mow the yard. And this was in Austin, Texas, 95-degree heat, 110% humidity, just awful thing to do in the summer. Nobody wanted to do it, right? And so I saw an opportunity. I was like, all these other houses on the block, nobody's mowing their yard. They hate doing it. They get up early on a Saturday and do it. So I was like, well, I'll do it for you for $10, right? And so it's back in the day, $10 went a long way. And I really wanted a Nintendo 64. You remember that thing?
Yes, I do.
Like Donkey Kong 64. You had the expansion pack. I wanted that system. And so I set out to make $120 because that's what I needed with tax to buy the system at the time. And I started mowing yards for $10 a pop. And these are the little bitty like quarter-acre yards. So it wasn't very much, but thinking back, I guess that was my first business venture. It turned out pretty well. I did get my N64 and then subsequently lost it because I broke the rules and mom grounded me. So is what it is, but here we go.
Donkey Kong. What was the other one back in the day? I remember when PlayStation came out, Crash Bandicoot was another big one.
Yeah.
Around that time. We're probably the same age, but yeah, we're in the sort of mid 90s when all that sort of stuff really started
something like that. And I remember, I think I got the Donkey Kong game, but then I bought 007 had a game out at the time, GoldenEye, I think it was.
Yes.
And I remember like when, blood would come down the screen. Anyway, it was kind of like cryptic and old, but my mother didn't like that. And so it was subsequently taken away until I was like 5 years older. So anyway, that's my childhood.
That's awesome. Mate, I mentioned in the intro, you're a recovering you're not a structural engineer, you're a recovering engineer like I am. I'm a structural engineer. Talk to me about that path, because we have a lot of engineers on the show who come into real estate. So to walk us through your corporate world and life, and then how you stumbled across wanting to be an entrepreneur and a real estate investor.
Yeah, it's a pretty short story, I think, that we can go through relatively quickly. But I was always taught at a young age that, hey, you have nice things. If you want them, you're going to have to work for them and get on a good path to get a good job and get them. So I did. I was always good at playing Legos and Connects and all that. And so the world told me I needed to be an engineer. I went and got an engineering degree. I got 2 actually, right?
Wow.
And and that led to first a job at NASA working on the space shuttle and what used to be called the Constellation program. It is now basically the SpaceX Falcon 9 rocket. So it was sold to them and they developed it and made it awesome, right? So it had a lot of fun making things go boom. I worked in combustion. I was a mechanical engineer designing parts that make things go boom. That, when the space shuttle ceased to be a project in our last economic downturn, I went into the private sector and I worked for, companies like General Electric designing aircraft engines and really enjoyed that until I looked around one day. I was probably, 4 or 5 aircraft engine designs in a lot of the commercial airlines you'd be flying around on today. And I looked to my left and I saw my principal engineer, and I looked to my right and I saw my senior engineer. I was like, oh my God, there are 3 companies in the world that do this. I work for one of them. And those 2 guys are me in the next 30 years. I'm going to be doing this. I'll just be very, very good at it, And that didn't sit well with me. I didn't like being pigeonholed, if you will. I didn't like the city I lived in, and there, aviation is not in the most pretty parts of the country. So that was kind of an eye opener. And then the straw that broke the camel's back was I designed a piece of technology that quite literally put this engine into a multi-billion dollar market. And I got like $1,000 and an attaboy out of it. I'm like, what? So that was kind of when the light bulb went off of, okay, I'm worth more than what I'm ever going to be paid ever. Right. Like the idea of the labor market is you will be paid commensurate with how hard it is to replace you and only enough to keep you from leaving. Right. Mm-hmm. So that light bulb went off. Well, so I started to despecialize. And at this time, you remember when GE used to be a great dividend paying stock and like was $50 a share and stuff. And then it went to like $4. Remember that? Mm-hmm. I was plucked for an interesting opportunity to kind of be an internal McKinsey and Deloitte or KPMG, like an internal consultant for GE. And my entire job for like 3 years of my life was to literally hop on a plane for 2 weeks at a time and go to every GE site in the entire world. Like Europe, Scandinavia, China, it was amazing. And my whole job was to increase, the bottom line, like by reducing variable cost productivity and manufacturing. So that was a rapid crash course in economics, business, profit and loss management, all the things we do as operators, right? And that eventually led to a global supply chain executive role. So I was, pre-30 and an executive with Fortune 100 company in the world or Fortune 50. I don't know what they are now. They've been cut up so many times, but, great experience, great background. But meanwhile, a parallel path was forming. I'm actually a third generation investor that was unbeknownst to me until I was in my mid 20s. But my grandparents owned a lot of single family real estate. And if you've ever watched the show Fixer Upper, Chip and Joanna Gaines, my grandparents used to live around the corner from Chip Gaines when they bought their first flip way back in the day. He's always been as goofy in person as he is in real life, by the way. I knew him when I was like 3. And anyway, so all of the property was in Waco, Texas. Their attraction to the market made everything do really well as operations. So that was kind of the family business. Well, granddaddy passed away, right? We called him T-Top. That's another story we can tell at the end if there's time. But T-Top passes away, and my now business partner and aunt, Kim, takes over the business. Well, this is around the time I'm asking questions and reading books like Rich Dad, Poor Dad and figuring out how do you make money? Because it's not sitting at a desk, right? And fast forward a little bit, now we have a business that I'm learning, she's learning. So we're kind of talking about it. Well, then we go study other asset classes and discover the scalability of commercial real estate. And then further, with supply and demand metrics at the time, apartments and unit-based mobile home parks and stuff like that really made sense. Started buying some of that with our own money. Then eventually people wanted to be part of it. So we started learning how do you syndicate? And so we figured that out. And it's just scaled from there. And, it was actually, I had parallel path careers until about 2020 when I saw COVID coming from China because I was in supply chain, right? And so I watched it hop from China, over to India, over to Europe, over to Scandinavia. And I was actually on one of the last flights out of Barcelona before the country shut down, right? Wow. So that would have been a fun conversation for my wife. Hey, I'm going to be here for a few months. And so it was in 2020 where I finally had to make a call because supply chain became a 20-hour-a-day job, trying to figure out how to ship parts in the shutdown of the economy for the first time since Noah's Ark. And beyond that, real estate also was taking a lot of time as we're trying to figure out, are people going to pay rent? What new regulations do we need to have? What's the cleaning standards? Like, what do we do? And so, this was the point in my life where I hadn't quite replaced the full salary. I definitely had a lot higher net worth, but how real estate can be. You can be real estate rich and cash poor in the beginning. And, but I knew I would land on my feet. And I went to my, my supervisor at the time, who was a senior executive, and said, look, I know GE's about to tighten the belt and cut rope with some people. I'm worth like 3 jobs. Just let me leave. Give me a severance package. I walked out the door, never looked back. And then since then, the business has scaled like 10x. So it's like once you start focusing on the right thing and just take the leap. And so that's how I got to where I am today. And that was the initial career path that got me there. I don't regret any of it. It made me who I am today, but I'm thankful that I found this entrepreneurial world and further hard assets to back it. So love it.
Quick question for you. How close were you becoming an astronaut?
I'm not going to lie if I didn't try or like think I could do it.
Yeah.
But the problem is before that, I wanted to become a pilot.
Mm-hmm.
And it was my inability to become a pilot that sent me to engineering school to design them. The problem is I have an ear tube that didn't close up. And so my ears don't pressurize and my vision is not perfect. Mm. And so the chances of me becoming a pilot went out the window, which means my astronaut chances were even lower. So despite the fact that I fit the little size window and I have the degree, I don't have the physical impeccable, perfection to do that.
I had to ask. It was the first thing. NASA, mechanical engineer. You're like, you're either going left or you're going right. You know what I mean? So that's awesome. So
I have met a lot of astronauts, but that's a different story.
Right. No, so now let's talk about Quattro Capital and what you've built, because you mentioned, and I think I've been on stage with Kim at IMN in Dallas. I believe
you were. That's right.
I hosted a panel at the IMN recently. How has it been? Maybe tell us what you got today, AUM, but also how's it been like with a family member? You're probably one of the first people on the show to build a real estate investment company. Maybe I just never asked, but a lot of the guys that come on like find a friend or a partner, through meetup groups or whatever. But your aunt, how's that going?
And I have to disclose, my mother, her sister, is a third of the 5 partners in Quattro Capital. So there are 5 managing partners. We have a lot of people that work with us and alliance partners as well. But the core 5 are 3 of them are family. Myself, my mother, and her sister, my aunt. Mm-hmm. Well, I'm not going to lie if I say we probably still fight like children. I mean, we love each other dearly. We care a lot about each other. The best part about working with family, when you're working with the right family members, is, there's a lot of money flying around in this business. There's a lot of trust. Like, this is the kind of family relationship where we know, like, no matter what happens, none of us would ever do anything to harm any of the other members. Like, the integrity is there. And so that really helped a lot in the beginning when we didn't have our systems and processes really tight, and we just had to trust a lot. Now we're auditable, which is different. But it's really been good, and it's been, Kim and I didn't know each other very well in my early life because she was a corporate awesome, like doing $1 billion deals with IBM and stuff like that when they were building data centers. So she was always gone. I then moved to Tennessee out of Texas where she was living. And so I didn't see her but once a year. We always had a good relationship, but I never knew her very well. So since we've started this business, I've gotten to know her as a person, found out we actually get along really, really well. And we challenge each other a lot, which is fun. And I had to learn to work with my mother, who was incredibly intelligent, but you have to learn how to, put that mother-son relationship to the side and work as equals, And so it's been really good though. I mean, we have built an incredibly strong company. We have aces in their places. Everyone does what they're good at. And, every now and then you see the claws come out when we step on each other's toes, but it's all in good fun and love. Right. So it's, I love the family dynamic in the business.
And what are you primarily buying? Is it all multifamily today? You mentioned mobile home parks earlier. I don't know if that is one of the asset classes you're also focused on.
Yeah, so we really like unit-based real estate. So we have not really come up with any self-storage buildings to date. We just haven't really found one that makes sense. We buy majority, scattered site multifamily or traditional, garden style multifamily. So that's the bulk of our portfolio, but there, amongst the partners, there's also some mobile home park type stuff. And, we just bought a piece of land in Texas that we're going to develop into tiny homes actually, that does have some mobile home park component on it. So, I really, what we're after is we're just not quite square footage based people, like even if you get into multi-tenant, that's great. We just really like the short-term nature of the leases, the fact that I've got 100 little bitty income streams and not one big one or even 7 on a building. It just really has been what we've gravitated to. And we believe in the basic needs of humanity, and shelter is one of them. Right.
Yep.
So.
Yep. I completely agree. Tell me how you're working through the current climate of buying in today's world. We spoke a little bit about in the green room before we press record here. But what's your outlook? Maybe take us back to last year. What were you hunting for? Have you bought anything recently? And how have things changed for you as an operational team from buying to operating to selling?
You know, what's interesting about that question is you have to ask yourself two questions, right? There's the macroeconomic environment that you exist in, which drives your capital markets, which drives your capital stack. And that's the aggregation of money you're going to use to buy a thing, whether it's your money, an investor's money, a bridge lender, a Fannie Mae, like whoever you use, you have to assemble this perfect little capital stack to buy your deal. And then you have to ask yourself, well, what's the health of the real estate market? And so let me answer the latter first. Yes, we're feeling interest rate increases, but if we put the capital side to the side for a minute, rents are still growing, at record levels. Even if they flatten out, we're still going to be in good shape for a time to come through this recession. So I think that the piece of real estate we're buying, as long as you're buying in areas that have the right economic indicators, population growth, job growth, the basic stuff, you're going to do well. As far as moving the income line. That's what we do as value add operators. We try to keep expenses or shrink them, which is usually a little bit of the value add, but mostly it is increasing the income line. That prospectus is no different than I saw a year ago, right? And in fact, it's worse. I mean, it's a delicate balance here, but now that you have interest rates I think they just peaked at 7% as of this recording yesterday for home mortgages, people are more priced out than ever. Building is even slowing down. It needs to be speeding up. We need to be building more homes. We're building less, and so the supply and demand imbalance for rental housing, I think we're in an area where we're going to see rent growth and occupancy for a long time to come, especially with inflation, where, we have a saying in Texas, shit rolls downhill, right? If you increase my taxes, you increase my insurance costs, you increase my cost of lumber, you increase my cost of appliances, guess who's ultimately going to pay that? Right? As long as you're in an area where incomes are rising, that is going to roll downhill to the consumer, and that consumer is the resident. So the health of the market, I think, is very good. Now, let's talk about the capital side. The capital side is, obviously we have seen an unprecedented move in interest rates. Like we haven't seen this since the 80s, and it's right. To combat inflation. We can get into all that. But how is it affecting us now? Well, the problem is you only run into problems in real estate in two situations. I can boil them all down to two. One is you run out of time, and the other is you run out of money, right? So if you bought a little bitty 20-unit building and you got $10 million in the bank, you're not going to lose that building, right? You can buy it 10 times over, right? But if maybe you bought it pretty thin and you don't have a lot of cash, and all of a sudden your variable interest rate went to 7%, you might bleed out and lose that property. So that's a risk. The other risk is a lot of people have tried to buy assets at sub 4 cap rates, and they've used bridge lending for the wrong reasons. They're kind of treating it like a permanent loan and just using it to get the deal, and then counting on organic appreciation to get them to a refi. Well, that's gone, at least for the immediate future. And those of you who may not have bought an adequate rate cap and may have a loan coming due in the next 2 years, look out, because that's going to be the challenge, and that's where you're going to see some correction in prices. So again, I see supply of deals starting to pull back because you have people who made good debt decisions. Like, I don't have to sell right now. Why would I sell in a situation where nobody can get a loan to buy this thing? I might try, but if they don't get the bid ask is so far out of whack, it doesn't matter. They just won't sell. The ones that are going to be trading in the next 18 to 24 months are the ones who have to trade because they're out of time or they're out of money. And so that's what we're looking for right now. We are not buying things at super aggressive cap rates. We're not running after deals right now because money is no longer free, right? Money has, when inflation was 2, 3, 4%, and your interest rates were effectively 2 or 3, that's free money. Like, I was using as much of that as I could and locking that up. But now money is, depending on short rates, it's 6, 7, 8%, long rates at 6%. And so, with inflation being right around there, money's about equal now. And you have to really be careful, because now you got to be prepared to hold things for 5, 6, 7, 10 years. You may not be selling things in 2 years because you got organic cap rate compression plus a little goodness on your operations. You may really be having to hold for that 5-year business plan. And so if you're investing, plan on that, focus on cash flow, because that is going to be what gets you through that time, the ability to cash flow over whatever this environment is that we're in. So anyway, that's how I'm thinking about things today, but there's probably plenty of directions we can go from there.
No, I think it's exactly correct. The first thing my opinion, and I've been transactional this year. I have bought a deal with variable interest rate at the beginning of the year. I bought a rate cap on it, which was good, but I then now have completely switched to fixed rate interest. Right, I think there's still deals out there to be had, and I think the price per pound that I'm seeing deals trade at or starting to be BOV'd at is very attractive. And I think if you can get the debt to work, which is the hardest part, right? Because you're going in cap rates are still around a 4.5, and you've got debt at 6.5, 7. That's going to be your hard spot. But what I'm also seeing is that, back to your point, we haven't seen this unprecedented interest rate rise, fourfold. Beginning of the year was 0. Now we're going to be approaching 4% by the end of the year. So it's fourfold. In the 70s, I think it doubled. It went from 11% to 22%, right? So we've nearly doubled what we did in the past in terms of how quickly we've shifted. Yeah. Even though historically people will say we're low, but you have to also, what's the growth, which is 400%. Yes. That's what I'm more talking about. But that growth has gone quicker than what people can get your business plan to work on, and that's what we mentioned in the green room before we press record. Is like, I think people are going to start to come into trouble because your business plan isn't keeping up with the rate in which mortgages or interest rate is going. And if you haven't got a rate cap, or you didn't plan to hit your rate cap until next year or whenever it was, you're going to start be squeezed with the mortgage, with your interest rate, because higher interest rates means less cash flow. What does that mean? Less distributions to investors, and you'd less DCRs, and then your banks will start breathing down your neck, the whole kit and caboodle. So I think there's a big storm brewing here, and we've all got to be buying correctly today. But how have you bought in the past is going to affect how you're going to exit some of these deals into the future. So with that being said, what are you thinking in terms of what are you trying to buy today? Are you trying to get, and with that same question, what debt are you trying to assume when you're underwriting that deal?
Yeah, that's a good question. And so, where I was, even just December last year, we bought a pretty big deal in Evansville, Indiana, a very landlord-friendly state, by the way. And at that time, SOFR was 0. And bridge money was probably, 300 spread, something like that. So it's like we had a 4% floating rate. We bought a rate cap at like 1.5%. We saw some tea leaves, of what was coming. Didn't know it would be this magnitude, but we saw it coming. But we wanted to kind of fix our rate, and we were putting 3-year terms with 2 1-year extensions on there. So I was effectively still giving myself a 5-year term. You don't want to run out of time, right? Mm-hmm. Today, I'm really, and I think to your point, bridge money is very expensive. And for the most part, it's no longer the most competitive thing to use. So we're sizing everything, like underwriting just got a lot easier. We're sizing everything for fixed rates, to your point, and we're actually looking at fixed rate low leverage, somewhere around like 55 to 60%, not only because that's all it will service, but because, most of these programs that you put on a 10, the non-floating programs that you put on a 5, 7, 10, 12-year deal, they will allow a supplemental mortgage later. And so the best thing that you can do is, okay, well, I don't want to have full leverage at 70 or at 7% interest or 6% interest. Try to get your equity okay with, okay, let's go in with lower leverage. Let's leave some room for us to do the value add. Let's capitalize in cash, and then let's go do the value add. And then guess what? You're going to be open for a supplemental later at 5, 4, whatever percentage that we're at. So your net interest rate will come down when you blend that together. And so that and between agencies and bank debt, that's what we're looking at. But we're also being very careful about the asset type that we buy. We have effectively offloaded all of our lower quality C-class product with, I'm sorry to say it this way, but there are certain resident groups in the country that will be affected the hardest, when the belt starts to tighten, the expendable laborers, right? And further, we've been pushing Class C Class C rental rates for 10 years now. Some of those people are already at 40% rent to income ratio. They can't afford a value play, right? Mm-hmm. So we are really focusing on post 1980, 1985 build, but maybe pre-2010, and really trying to find that mixture of renter by necessity, renter by choice group that is also in an area that's willing to, if we were to create a superior product, start to compete with that A-class product, but at a lower level. So we're really in that hyper niche. It's a good resident base to hold, mostly your white collar resident. For example, they're pandemic resistant. If they had to work from home, they could. And so that's really the niche of what we're looking for. And I really like to see it, in that 75 to 200 unit size, because that really gives you good economies of scale. So there are still value adds out there to have. You have to know your numbers. You have to be on top of your construction costs right now. And you really just have to mitigate as much of the local debt risk as you can and keep your eyes to the horizon, because real estate is a long game. There will be pain for about 18 to 24 months. There will be utter pain for a lot of people. But beyond that, once we know where the bottom was, that's the only way is you look back over your shoulder and say, there it was. Now we can get back to growing, right? And so we're always buying, but it's got to be use the right strategy at the right part of the cycle, right?
Yeah, no, I completely agree. And what is your thoughts on the how are you going with your operations versus that rate increase? Because I mentioned that before. A lot of people, getting in deals, getting started, getting the GCs going, it takes a period of time. It doesn't you don't just close a deal and all of a sudden 2 months later you've renovated 25% of your units. So there's the interest rates have gone quicker than the business plan. Have you seen that in your personal portfolio as well?
Oh, sure. And, I think our standard underwriting practice was, we're because you got to think the seller usually, if they're operating well, they're renewing 60 to 90 days out. So your first 60 to 90 days pretty much already signed, right? Not always, but pretty much already signed. We're in a unique position right now in a deal we're doing in Houston where, the seller has let 15% go vacant for reasons unbeknownst to me. But now we have 50 units we can go after right there, So it is possible to blitz it out of the gate, but that takes turning plans into scope pre-close and being ready to hit the ground running with shovels and hammers, on day one. That's challenging. But usually, you don't really have the opportunity to renew people until month 4 effectively. And we usually are taking that time to get the template right, turn plans into scopes and turn it into action. It really takes a solid quarter coming out of the gate to get going in general. And you can force it, but it'll be clunky and then you'll figure it out and hit your stride. So, there's definitely a point to where this is just physics of value add. Your business plan or your profit and loss statement will look worse than the seller's until you hit enough units to come out the other side, because you have to induce vacancy. And especially pretty much 100% of the time when you take over a building, your taxes go up, your insurance goes up, your interest rates probably, at least today, is up, and you're going to see some turnover. So your net income, your net operating income is going to drop. So you have to be able to withstand that dip and then get to work and come out of that dip. And, on average, I think you come out of that dip around month 6, best case scenario. So, so the problem is you have to be able to withstand that impact year one. And to your point, it's one thing when you're buying with like a 5% interest rate at a 4 cap, but when pricing is still at a 4 cap and interest rates are like 6 to 7, that is a huge economic headwind when you're trying to come out of that gap. And so that's really what's driving the bid-ask problem. Not that we don't think we can add value to properties anymore, but it's how do we get out of the gate safely? And then subsequently, if you're using short-term financing, how do you hit a refi in 3 years? How do you project that value? So definitely affects it.
Question on the refi. Cardinal rule for me, and this is the way I've operated, I've never, ever underwritten to a refi ever, right? This is going back, I've been doing this for 8-9 years. Now that you're coming in and you're seeing, the only thing that really makes sense to your point is, okay, let's go get more equity than what we need. We're only going to get 50 to 60% leverage. And we're hoping or we're betting on a better interest rate environment in 2 to 3 years' time. So are you now underwriting to a refi in your models, knowing that, or betting on the fact that the interest rate environment will come back and you get to replace some of your money at, say, instead of, you might be paying 7% today, but you're only 50% leveraged, and then in 3 years' time, you might get it down to 5% or 4 and change, and you might be able to push it to 65% or 70%.
That's a great question. And, honestly, I'm going to start by saying this is a philosophical question. And I have always underwritten to reasonable reality. If that includes a refi, it includes a refi. But let's think about it this way. First of all, a wise mentor in the engineering world once told me, all models are wrong, but some models are useful. Like no matter what you do in life, like if you try to go predict the performance of an airplane, I guarantee you those cowboy pilots are going to run the thing a lot harder than you plan. So all models are not correct, but you have to predict things well enough to not break the airplane in mid-flight, right? So the way I think about this is, let's talk about tolerance. If I'm manufacturing a part, most people don't know this, but if I say a dimension on a part, let's say a wheel or something is 24 inches, if I go make it, I can't make it 24 inches 100% of the time. Some are going to be 25, some are, maybe smaller. Some are going to be like 24.2, some are going to be 23.8. Like there's a tolerance on what you can actually achieve in manufacturing. And so let's use another analogy and say, okay, when everything is perfect and you're in a manufacturing shop floor and you're sitting on, an anchored piece of machinery, you can get those tolerances pretty tight because you have certainty. The environment around you is certain. Now let's think about making that same part in an earthquake out in the middle of a field, right? Your ground's moving underneath you, the part's moving, your tool and your cutter's probably hitting different ways. So you're gonna, when the environment around you is not controlled and not certain, you have to widen your tolerance band or you're gonna scrap more parts, right? So the point is, whatever we underwrite, we look at tolerance bands. And so let's talk about how we would underwrite a refi. Yes, we would say, okay, I'm doing a bridge loan, so there is a 100% chance at some point at the end of that term, I will have to refi the deal, right? So I have to think about that, And so if let's say we have a 3 + 1 + 1, and we're going to target a refi at the end of year 3, but we have our extensions as back off, right? But so now we have to figure out, okay, if I'm taking, let's say $30 million in a bridge loan, I've got to look at, how do lenders who I'm going to refinance to, let's think Fannie, Freddie, HUD, Fannie, Freddie, Ginnie, how are they going to look at, my takeout loan? Well, they're going to say, okay, what is your loan to value? And that's going to be based on a cap rate in the future and your NOI. And then, what is your debt coverage ratio? And so what we have to do is predict what that is going to be based on our future NOIs. Right now, value is not a problem. I mean, most of our stuff looks like 40 or 50% loan to value in the future, depending on, and you run a cap rate sweep. Maybe you run something from 4 to 6 and you see what happens. And can you always hit that value metric? Right now, you're limited by the debt service coverage ratio. And this is why lenders are backing off on proceeds. Is they don't want to assume an aggressive situation at refi. You've got to look at what proceeds you have now, and then look at a point in the future and look at all the rate indications and think about, okay, well, if I assume the rates probably aren't going to be 3 anymore, so maybe their best case 4.5, and maybe their worst case 6.5, like what they are today. Okay, well, you start to look at that and figure out in how many cases can I hit a 1.25 debt coverage so I can actually refi the thing out, right? And so that's what drives your decisions. So, we're of the mindset that and by the way, none of this is wrong. As long as you make the right decision, so you have, you have a safe deal and you make money, it doesn't matter how you do it. We consider what is the reality of how we're structuring the deal today. And then what is the reality likely to look like with some tolerance? And right now, that tolerance band is a lot wider than it used to be because the ground is shaking around us, So.
No, I think it's poignant that I heard on a podcast the other day, like we as entrepreneurs, real estate entrepreneurs, we can make money in any environment, right? We just need to know what the rules are. And back to your ground shaking analogy, the ground's shaking so much, we still don't know what the rules are. Hence our tolerance bands have got to be bigger. But as we start coming through these wavy, choppy waters, we will start to see the horizon amongst the clouds, and we will all start to bring that tolerance band in again and be able to make assumptions that we feel good about. And goes back to the question of like, do you assume a refi? Well, if you believe within your tolerance bands, you can assume a refi, and it makes sense, and you have the upper limit and the lower limit. And you feel good about that. You feel good about your operations. You feel good about where you're buying at and where you want to move the needle to. Then The answer is yes. You can go look at a refi.
Yeah.
So I completely agree with that as well. I know personally, I'm looking at deals today, and it's just like, okay, so we're coming in at 6.5. Do we really think it's going to be 6.5 in 3.5 years' time? And what can we push the needle to on the NOI? So it's all
and that's the thing to think about right here is like, now that, and I even said we are looking at fixed rate for things going forward right now. Like right now, the tolerance band has gotten so wide that I don't even want to risk it. Right. It's like I'd rather just say maybe I'm paying a stupid high rate for but if you get a bank loan for 3 to 5 years, okay, maybe I pay 1% to get out of it and I can refi to something better later. But the alternative is if I'm not underwriting a wide enough tolerance band, or it's so wide that on like half of it the deal works and half of it doesn't, it's not a safe confidence interval to buy that deal. So you have to figure out how to get your confidence interval safe and mitigate your risk. And right now, I think fixed rate is like, if you're starting a deal today, I think fixed rate is probably the way to go.
Fixed rate, but I'll also add, you don't want to be locking in your fixed rate with a Freddie or Fannie on a term where you have defeasance, and that will kill you anyway.
Yes, that is worse.
You have to. Don't be naive. Like, yes, fixed rate, but don't then go and fix it for 10 years at today's lending environment, because then you're stuck. And to get out of it's going to cost you an arm and a leg. And I've been in that situation before.
We've all learned that expensive lesson. And let's talk about that for a second, Reed, because the behavior of yield maintenance and defeasance, which are similar but different, the behavior of them is that there's an equation, and it's about this long, and it's in your loan documents, and you have to have them calculate this for you, or go to defeasewithease.com, and it's pretty handy. But anyway, you can calculate this for your deal. But what people don't understand is it's inversely proportional to interest rates. So think about this. If I'm a lender and I'm putting out money at 3%, as long as money's still 3%, that defeasance to get out of that loan is super high because you hadn't fulfilled your obligations in terms of interest for that investor. But the interest rates are now 6%. If you have something locked in at 3%, and I do, I'm looking at selling it right now, your defeasance is like nothing, because they're like, give me that money back so I can deploy it at 6%. But the inverse is also true. So the worst thing you can do is lock a high rate like 6% right now with a 12-year term and defeasance, because I will tell you with pretty much 100% certainty, by the time we get 6 to 7 years out, rates are going to be lower than today. I mean, I'll be really and I've been wrong before, but if history tells us anything about the future, that is certain, right? The question is the near term, not the long term. So what'll happen there is, you will lock in at 6%, and then rates will be, let's say they go back to 3%. I don't know. Well, that lender's like, I don't want that money back. Your defeasance just went up because I'm making more money with you. And if you terminate that loan, it's not as good of an investment for me. So you got to think about that, as locking high with defeasance is a really dangerous thing, and it'll be expensive, so unless you're married to the deal,
You completely agree with you, mate, because I remember having a deal even back in 2016, if you remember, rates were sort of going up at that point, and we thought we were going to the moon. And we locked at 4.63% on a 10-year, but the business plan was 5 years, right? And this is the naivety of being a newer syndicator. We still have that deal today, because if we try to get out of that deal, it's still going to cost us like $1.5 million to $2 million to get out. So the other thing you got to look at is, and this goes back to floating rate, the difference between getting a defeasance, getting out of it in 3 or 4 years' time, versus what a rate cap is today. You have to look at those two and evaluate what's the best for your deal, or look at a step down prepay, because that's probably the best thing you can do. Or if you do really believe that you think rates are going to come down, get a floater, pay the rate cap, and just get something that is moderately leveraged in order so you can set yourself up for success in 2 to 3 years' time. You can jump that hurdle. You can get the DCR at the 1.25 and replace that the senior loan that you closed on the deal with.
That's absolutely right. And I'm going to give your listeners some some nuggets of how I do this here. Like this is something, it's very numerical. You can figure this out. Does it make sense to buy a rate cap? Does it make sense to float my debt? Does it make sense to lock something and look at future defeasance? So the first thing I gave you, go to defeasewithease.com. And it doesn't have to be a real loan. You can put in parameters and figure out what will that defeasance be at a given time, maybe 5 years into your business plan. So you can predict based off what things are today, what that would look like. and you can play with the rate and figure out, like how that defeasance would change. Now, rate caps, you can go to pensford.com, Pensford, and they have this great little calculator at the top right called a cap pricer. And they update it weekly, I think. So it's pretty accurate, I found. But you download this spreadsheet, and you'll have to read about the terms a little bit. I'm not going to give you a crash course on that, but you put in the parameters of the rate cap, and you get a pricing matrix, and you can show, there's a little box you can play with the interest rate assumptions and see how well it pays out. It's effectively an insurance policy, guys. You're just saying, if rates are here, I'm only going to pay up to here, and then the policy is going to kick in, right? And so with that, and then knowledge of your interest rate and interest and loan amount, you can figure out, does it make more sense for me to just hold extra cash and pay the extra interest risk if it happens? Or does it make sense to pay $500,000 for a rate cap? Does it make sense to do a step down prepay, which is a very easy way to calculate like a 5, 4, 3, 2, 1% of loan over 5 years? Or do defeasance. So like, this is calculable, and I encourage you all to become students of the capital markets, because the capital, you can be the best operator in the world. If you don't know shit about creating a capital stack, you're going to die. Seriously. Right. Like you will not live in this business. So.
Well, Chad, mate, I could talk to you for hours, my friend. But at the end of every show, we like to jump into the top 5 investing tips. You ready to get into it?
Let's do it.
Mate, question number 1 is, what's the daily habit you practice to keep on track towards your goals?
Daily habit that I track. Something amazing happens to the body when you just drink water in the morning and don't eat until at least before 9 or 10 o'clock. The brain focuses on survival, and it's very alert. And I also get a workout in. It's like, that may be 5 a.m., it may be 8 a.m. when I do it. But before I start my day, I make sure I get that workout in, and I make sure that I'm fasting until at least mid-morning. And you'd be surprised how alert your brain is, how your metabolism increases, and how just like your brain is in a different state of mind when you have had that workout and feel that level of accomplishment. It's kind of like, what was the guy who said, one of the generals said, the first battle of the day is making your bed. It's like, just get a small victory, and then you can conquer the world.
Love it. How often or how long are you fasting for, just quickly? 12 hours?
I usually, no, not that long. I'll do a drinkable yogurt or something, probiotic thing, like in the morning, maybe around 9 o'clock. And I usually don't eat until lunch. I don't eat breakfast. I'll eat probably like a 500 calorie lunch, maybe. And then dinner is my bigger meal. So I'm more on that level of fasting. Yep. So not like 12 hours, but.
Yep. Got it. Question number 2 is, who's been the most influential person in your career to date?
Wow, that is, there is an individual out of California he was a big guy with CB Richard Ellis for a long time. I won't speak his name for privacy, but he's also been a pref equity partner in a lot of my deals. And man, the knowledge that man has on the market, on deal structure, on operations, like I feel like just having conversations with him, I get exponentially smarter, right? So just having people like that in my life, and that would be the main one. He's an old guy. He's a gray beard. He invests in operators, and he sees something in me for whatever reason and gives me his time, which is amazing. So like that, I owe a lot to that guy.
That's awesome. Question number 3 is, what's the most influential tool in your business? And when I say tool, it could be a physical tool like a phone or a journal, or it could be a piece of software that you just can't run the business without. What is it?
It's interesting. I'm going to go with a personal productivity tool. So I use a email client called Superhuman, and it's a new thing it's very like keyboard and shortcut based. And it's amazing, like how I can customize like my inboxes for context. Like if I'm working on 4 deals, I need stuff to get in the right spot. It's super flexible, and it really helps me stay on top of things very quickly. And I'll give you a second one, a bonus one. I love writing things, but I hate paper. I bought this little Remarkable tablet. Sorry, you can't really see it with my blur, but I bought the Remarkable 2, and it's a real low tech thing. It just, you can write and you can have notebooks and all that in there. I use the thing constantly. Like when you just need to think, or you just need to plan, or like you need to have a place to jot notes, it's always there. The battery lasts for like a week, So that, like those two, that's a tech tool and then a efficiency tool, I would say.
Awesome stuff. Question number 4 is, in one sentence, what has been the biggest failure in your career? What did you learn from that failure?
Biggest failure or value?
Failure with F.
Failure. Okay. Yeah. Sorry. It's the Aussie redneck.
Aussie. Yeah, exactly.
My redneck doesn't quite compute Aussie. So the biggest failure, that is a great question. I would say I'm trying to think of something that's not going on, in the recent past, with something that's given a lot. I would say what I said earlier, not understanding capital markets well for when we started doing these larger deals, because in that whole defeasance discussion we talked about, we made that mistake where we locked something for too long and we added a lot of value and we had a couple $1 million in equity stuck. It's called dead equity, right? And it's still stuck to this day because I will not pay that defeasance. Even today, it's not a great story to sell it. So anyway, I missed my window there to recapitalize and roll that money, and that was an early deal. So that my refi and roll plan fell on its face for that. So learned a lot from there that you need to know capital markets.
Mate, we're cut from the same cloth because I made the same mistake. So awesome stuff, mate. Last question: where can people reach you to continue the conversation? They're in your sphere. Where do they go?
We are all over Facebook, LinkedIn, and Instagram. Look for Team Quattro Capital, all one word, no spaces. And if you go to thequattroway.com, that is our website. You'll see our managing partners on there. You'll see our extended team, our podcast, our deals. Like, you can just do all things at that website. So love to connect with you. And always love talking about this stuff.
Awesome stuff, my friend. Look, I want to thank you so much for jumping on the show today. Just to repeat some of the things I took away from today's show, I think the number one thing is all models are wrong. Some models are a good guide. And I completely agree with that. Like, a model is a snapshot in time and you cannot control time. We don't have a crystal ball. If we could control time, we'd be doing something completely different. It is just the best guess that you can have of where things are going to go. And then the second piece of advice I thought you spoke really well on today was tolerance bands. So in and around your model, how big are your tolerance bands and where is it going to point to make sure that you have the best exit and the most successful operations possible for your investors to preserve their downside and to protect their capital. So I think those are the two big takeaways. Did I leave anything out? And is there anything else you want to add before we wrap?
No, I think you hit it very well. And I guess the last piece of parting advice on all models are wrong, submodels are useful. Whether you're an operator or you're investing in operators, you're investing in the people driving that model, right? And so the model is wrong day one, I'll tell you that. The question is, how well think about a GPS. There's going to be detours and construction. How well can that operator navigate around the map and stay on course as much as they can? Because something will go wrong in the first week. I promise you, it's just life, right. But that's really the key, is how well can you track to plan, not emulate plan.
I love it. Well, mate, thank you so much for jumping on today's show, and enjoy the rest of your week, and we'll catch up very, very soon.
Thanks, Reed.
Well, there you have another cracking episode jam-packed with some incredible advice from Chad. If you do want to check out Chad, head over to thequattroway.com or just search Team Quattro Capital on LinkedIn or social media or on Google, and you'll be able to find everything they do. Connect with them, get involved in their sphere, because they're doing some incredible stuff in and around the space of multifamily and mobile home park investing. And just have a good way of philosophy about thinking about what they're doing and how they're executing in today's world. I want to thank you all again for taking some time out of your day to tune in to continue to grow your financial IQ, because that's what we're all about here on this show. If you do like this show, the easiest way to give back is to give it a 5-star review on iTunes. You can check out all the show notes from today's show up on my website at reedgoosens.com. And we're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.